All right, so Bitcoin has finally shown some signs of life, right? We saw that big bounce and now everyone's talking. But the big question is this the real deal? The start of a true recovery? Or is it just a temporary blip on the radar? Well, today we're going to cut through all that noise and look purely at the on-chain data to see what the blockchain is really telling us. So let's dive in. So yeah, that's the central question we're all wrestling with. That roughly 15% jump we saw, was that the beginning of a sustainable recovery? Or was it just a relief rally in what might still be a broader downtrend? The on-chain data actually gives us a surprisingly clear picture on this.
Okay, let's start with the case for a recovery, analyzing the bullish signals. First, we'll look at the optimistic side of the argument, and there are some really solid, data-backed reasons why this bounce happened exactly where and when it did.
You see, the bounce began at what we call a mechanically significant level for investors. Now, what does that mean? It means this wasn't just some random point on the chart. The price found support exactly where the on-chain data predicted a whole lot of buyers would step in to defend their positions. It's like a financial line in the sand. So what was that critical level?
It was right around $85,000. Now, that number is tied to a really powerful new on-chain metric, the Bitcoin ETF Realized Price. Basically, this is the average price that all the spot ETF investors paid for their Bitcoin. And when you think about the billions and billions of dollars that have flowed into these ETFs, well, that average cost basis becomes a massive psychological and, frankly, financial support zone.
And the timeline of events really backs this up. It's a pretty clear sequence. First, we saw the Coinbase Premium Gap start to rise. That's a good indicator of U.S. institutional demand waking up. Then, in early January, that was followed by a string of strong ETF inflows. And what happened next? Bam! The Bitcoin price bounced about 15%. So the data is pretty sternly suggesting this wasn't just retail FOMO. This looks a lot more like strategic, calculated buying.
So all of that sounds pretty bullish, doesn't it? But here's the problem. The story doesn't just end there, because the data also shows a major roadblock that this rally ran straight into. It's like it hit a brick wall.
Which brings us to our next section, the overhead resistance, where we'll examine the bearish signals. So let's flip the coin and look at the other side. Because, as you know, for every strong support level that holds, there's usually a tough resistance level waiting just above it. And, well, that's exactly what played out here. All that upward momentum just got stopped cold. This rally only managed to push the price right back up to the top of its recent trading range, a level that has, time and time again, acted as a very solid ceiling. And that ceiling? It's sitting right around $94,000. The price rallied directly into that level and was just firmly rejected. It's clear confirmation that there's a ton of selling pressure waiting right there. This isn't a new barrier, it's a formidable pre-existing resistance level.
And if you zoom out a bit, this resistance picture becomes even clearer. Right now, the price is trading below the average cost basis, the realized price, for two really critical groups. First, the short-term holders, so basically anyone who bought in the last 155 days. And second, the whales, the largest wallets in the network. What this means is that both recent buyers and the biggest players are, on average, underwater on their positions. And that creates some serious overhead supply pressure, because these folks might just be looking to sell the moment they can get back to break even.
So here's the bottom line. When you weigh all the evidence, you have a strong bounce from a key support level, but it gets slammed down by some major overhead resistance. The data really points to one clear verdict. This whole pattern fits the classic textbook definition of a bear market rally, or what we often call a relief rally. It's a temporary jump in price that just can't manage to break through key long-term resistance. And by definition, a rally that gets stopped cold at a ceiling we already knew was there, well, that doesn't signal a real reversal in the trend. So let's talk about the level to watch, the path to a bullish confirmation. What does this all mean for you as an investor or an analyst? Well, it means we now have a very clear, data-driven level to keep our eyes on. This is the level that's going to tell us if and when the trend really starts to shift back to being bullish. Which brings us to the big question, right? What would it take to signal a genuine trend reversal? What would have to happen for us to say, okay, this isn't just a relief rally anymore? The answer is simple and it's precise. $94,000. That is the line in the sand. For the narrative to change, we'd need to see a clean, decisive break and, this part's important, a daily or even weekly close above that level. If that happens, then Bitcoin finally has the breathing room it needs to start tackling those other on-chain resistance levels and begin rebuilding a truly bullish market structure.
And really, that brings us to our final thought, which is summed up perfectly here. Price looks alive, but the market still needs proof. Look, this recent bounce was absolutely important. It showed us the price isn't dead, that buyers are there, and they're defending key levels. But until that critical $94,000 resistance level is broken, the market is still asking for proof. And until we get it, this move has to be seen as relief, not confirmation.